Today's an example of when it's really dangerous to use a lot of limit orders. And I mean that in the sense of not what you're thinking, not the obvious, it's a very tight channel, you may get a breakout. It's the risk of a collapse or a quote unquote crash. And when I say that, what I more mean is you could be buying and who knows, maybe you get a bar that falls 20 points, or maybe the next bar is 20 points and you take an incredible loss or you get slippage. There's always the risk of something screwing up when the market's moving extremely fast. So if you are, in this case, you're buying, and you're buying because the logic does make sense. You're very far from the moving average. It's extremely climactic, so you're probably going to go sideways. And common logic on most days, you buy here, scalp out for, close to the moving average. In this example, generally it's probably best to use some sort of limit order. Generally it's probably better to use some sort of options strategy. So you just buy a call and on the SPY and take your profit, because that significantly would reduce your risk of a collapse and would minimize it. Anyways, on a day like today, never get frustrated about what happened. If you're fortunate, you see the bear breakout follow through and you sell. And maybe you take part off, you think measured move from the open to the close, measured move down. But you keep getting this, and maybe you keep a small portion on, but your stop's really far. You're thinking, okay, this probably ain't going to go much further. It's probably climactic, sideways for a good portion of the day. Bulls made money, then surprise. And generally right here, you'd be thinking, okay, very tight, 3 pushes down, but probably going to go sideways, and then that happens. And it's so easy to get lulled into thinking, hey, this is, too far too fast, I'm just going to start buying. And if you do that, you think, oh, thank goodness, I can buy more here and I'll finally get out of break even. Well, not quite. So easy to take a big loss, and really better just to wait for the market to go sideways. So over to here, sell the close, still sell the close, but it's very climactic. So if you're short, stops up here, probably up here. I'd probably put it above that bar. And no reason to get out, no reason to get out. I'd probably get out above that bar. So that's where it gets difficult. Personally, more than reasonable to get out there. And you can see what happened. Bulls were expecting some sort of double bottom and buyers below. But the hint is micro channel here, 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 here. And then, if you're buying lows, look what's happening. 4 consecutive bear bars. A strong breakout bar. Okay? So that's 5 consecutive bear bars. It's a micro channel. It increases the chances of trap traders. And then a follow-through bar. And here we are. So hope this helps. At the end of the day, the whole point of this video is to be very careful when the market's selling off strongly or rallying strongly about counter trend fading with limit orders, because it just takes that one day that can devastate you.